Welcome, everyone, to the final session of the Modern Investor Summit. We've had an incredible 2 days packed with insights, strategies, the latest trends in investing, and we're closing out the summit with a truly special keynote speaker. Joining us today is Greg Davis, the Chief Investment Officer and President of Vanguard. Greg brings a wealth of experience and insight into the investment landscape, and we're absolutely thrilled to have him share his expertise with us today. So without further ado, please join me in welcoming Greg Davis. How are you doing, Greg?
I'm doing well, Max. Great to be on with you today.
Thank you so much for taking the time to speak to us and to engage with our community today. What I'd love to do is start off just by painting the broad picture for our audience, then dive a bit more into industry trends and Vanguard's positioning, and then finish it off with some quick fire questions, if that sounds all right to you.
That sounds perfect. Look forward to it.
So we're approaching 2025. You've had in the US a very significant election. The US economy has been going strong. PE ratios have been incredibly high. Some have raised concerns that this cannot be sustained for too much longer. So my first question to you is, what is the economic outlook that you have for the rest of this year, but more importantly for next year?
Yeah, Max, it's a great question. I'd say, coming into 2024, most economists expected to see a pretty significant slowdown in terms of economic growth in the U.S. And what I would say is that the economy has outperformed most people's expectations, including our own. And there's been a number of drivers that have really contributed to that. Number one, the labor force has been unbelievably strong. We've seen relatively large amounts of productivity growth in the marketplace as well. We've seen a really healthy consumer who's really helped drive, economic growth in the U.S. And, we're expecting economic growth this year to come in somewhere in the neighborhood of about 2% or so when we think about the full year. And then when we think about what's going to happen in 2025, we think a number of these same tailwinds that have propelled the economy in 2024 will continue to persist as we go into 2025. And we're looking for economic growth next year to also be somewhere in that 2% or so type of range. And then if we look more broadly, if you think about places like Europe, we're seeing a significant slowdown in economic growth there. A country like Germany is expected to be in or close to a recession at this point in time. When you look at the economies of places like China, China's also been underperforming expectations where they were expecting 5% economic growth in 2024, and it's likely to come in closer to 4.5%. And a big headwind in China ultimately is the fact that the housing sector continues to be relatively weak. We've seen housing prices decline by about 10 percentage points in China, and there's over 40 million unsold homes in China as well that continues to weigh on the property sector. So, some very mixed dynamics when you look at the global landscape, but the U.S. continues to be relatively strong given everything else that's going on.
And do you, if I could just double click on your outlook there for next year, do you envisage the tech industry, I guess primarily driven by AI, to be one of the key drivers of that growth next year, or will it be a more diversified growth driver?
We think it's going to be a bit more diversified, but we do think technology is going to be a key catalyst. So when you think about, and I'm sure we'll talk about this at some point, when you think about the impact of artificial intelligence and how that's going to be helping transform not just the technology industry, but the usage of that technology in a number of different fields, I think is going to continue to help boost productivity growth for employees. And ultimately, that's going to help the businesses attain greater economic growth as well.
And so Greg, you've been in this industry for 30 years. You've witnessed it transform on a number of different levels. In your view, for our audience, what are some of the most significant dynamics that investors will need to navigate in the years ahead? You already touched on a few, but just more broadly, what are some of the key things that people need to be aware of as they navigate their investments?
A big part of it, Max, a big part of it is, taking a look at the environment that we're in. So, when you have an election in the U.S., there's always concern around volatility. We've had a pretty robust geopolitical environment with everything that's happening in the Middle East and beyond. And so a lot of folks ultimately get concerned about, some of these major macro dynamics. But what we would always say to investors is that focus on the things that you can actually control. There's always going to be uncertainty in the marketplace. There's always going to be volatility. But at the end of the day, investors have to focus on the things that are important to them, figuring out what their investment goals are. How much risk do they want to take? Trying to make sure that they implement their investment plan in a highly diversified manner, and also making sure that they're trying to maintain low costs when they're investing in a variety of different products and services to help achieve their long-term goals. So investors should, again, take that long-term perspective and control the things that they can control, and don't worry about the things that are outside of their control, and tune that noise out.
And do you think one of the drivers, kind of linking back to what you were talking about, the forecast for the US economy as well, are you at all concerned, and should investors be concerned around the incredibly high debt levels that we're seeing in the US? Is that something that they should be thinking about?
Well, again, when you think about the budget deficits that we're running in the U.S., slightly below 7%, it's relatively unheard of when you're not in a recessionary type environment. And that is the concern, that, debt to GDP, the deficits, they all will rise pretty substantially if you get into a recessionary period. The reality is that, interest rates have been pretty well contained, even though we're running relatively large budget deficits. But at some point, it will start to crowd out other investments and other spending with the U.S. budget. And so there is concerns that it gets to an unsustainable level. The question just becomes, how rapidly does that happen? And a big part of that is going to be the amount of economic growth that we have in the U.S. And, can we grow out of, some of these budget deficits and, the rise in debt to GDP. So it's to be determined, but it is starting to become concerning.
And one last question on that topic before we move on. We talked about the election very briefly. I think generally economists were in consensus that interest rates were going to continue to drop. Now, obviously, Trump has been elected, and the broad consensus appears to be, you let me know if you disagree, that his policies will be inflationary, which will have an impact on the speed at which interest rates might be lowered. Do you have a view on where you think interest rates might be going as a result of these election results?
Yeah, well, I'd say it's a couple things. There's a couple things to unpack there, Max. The first thing is, like, when we came into 2024, most market participants were expecting, the Federal Reserve to cut interest rates somewhere in the neighborhood of 200 to 225 basis points. The reality is it's been nowhere close to that number. The expectation is we get one more rate cut. There's a 50-50 chance that we get one more rate cut at the December meeting. And the expectation from our economic team is that the Federal Reserve ends up stopping somewhere around 4% at the end of 25. So again, substantially less than what most people had anticipated coming into the year. Now, in terms of the implications of that across the yield curve, so when you start going out to 10-year bonds and things of that nature, the reality there becomes, what does the market think in terms of the amount of supply that's coming in, and what are inflation expectations? So if inflation continues to be well anchored around 2%, 2.5%, could you keep 10-year interest rates similar to the levels that we're at now, somewhere around 4.25%, 4.5%? It's very likely. Now, if inflation starts to rise, or we start having significant concerns around the amount of debt that's being issued, and there's a concept called the term premium, and that's the amount of extra interest that investors require to invest further out the yield curve. And so if you see that term premium start to rise, and it has risen more recently, that could cause a rise in 10-year rates and 30-year rates over time as well, which could be concerning. But again, we don't think that long-term rates are going to become unanchored, just given the election results or anything of that nature.
Okay. If we switch gears a little bit now to passive investing, clearly it's disrupted the market. It's become ubiquitous. From the research that we've done within our own community, pretty much everybody is using some passive products. And so the question I have for you is, as they've become so ubiquitous, is there a risk that they turn into commodities or commodity-like products where the end consumer struggles to differentiate why is one better than the other, except perhaps for price? Is that something that you're seeing, and how do you think about addressing that?
Well, I think there's a couple things there, Max. First is that all ETFs are not created equal, and although it sounds simple to do indexing and ETFs and all those types of things, it's actually pretty complicated to do it well. And so the first thing is, like, you want to make sure that you're investing, number one, with somebody who's giving you access with a highly sophisticated process, a really strong team that knows the ins and outs of markets. And the benefit of scale, large investors like Vanguard and others, we have global teams that operate in all the respective markets in real time. We can send trades, into the Asia Pacific market, into the European markets, Middle East, because we have folks who are working in those time zones. But investors should be very cognizant of what's the cost to actually getting that exposure. And so what we would always say to folks is, again, make sure you go with a reputable firm, make sure that you're looking at cost, but also recognizing that every ETF is not created equal. So you want to understand what's the quality of the team and how successful have they been in managing ETFs, index funds in very volatile investment environments. And the great news for Vanguard is, we've been at this for a very long period of time, and we have a highly experienced team that has been able to perform in a variety of different market environments to continue to produce really, really strong results for our clients that give them, market exposure across the different markets in equities, in fixed income, and they come to a name like Vanguard that they can trust and rely upon to give them that market performance.
And looking into the future, where do you see passive investing evolving into?
Yeah, it's a great question. Number one, I'd say the first thing is that we expect that it continues to take market share in the marketplace, simply because a lot of financial advisors, a lot of individual investors don't want to spend their time analyzing individual stocks and bonds, right? And so a lot of advisors will spend their time making sure they're crafting portfolios from a asset allocation standpoint that makes sense for their investor, given their backgrounds, their risk tolerance, and their investment goals, and ultimately spend their time getting them that beta exposure. And they might supplement that with some alpha at the margin by trying to identify some, strong performing active managers that can help supplement that beta exposure. But again, we think this area of the marketplace will continue to grow. And if you think about where does it have the most potential, we would say on the fixed income side. Again, fixed income indexing is still relatively small. It's probably a decade behind where it is on the equity side. So from an opportunity to continue to ramp up and see growth in that area, we think the fixed income indexing is an area that will probably grow a bit more rapidly over the next 5 or 10 years.
And do you see technology, AI, or any of the new technologies really that have been rising? Do you see any impact on how passive investing will evolve, or do you think it's sort of two separate trends that won't really interact as much?
Well, it really depends on the firm. Again, when I think about how we plan on using the technology and our whole platform, the ability for us to manage 6.5 trillion of equity assets, and the fact that we're able to manage, 2.5 trillion of fixed income assets internally, a big part of that is the leveraging of technology, having global platforms. And a big amount of our future investment spend within my group is really around making sure we're leveraging technology to the fullest. My team and I just went out to Silicon Valley last month, and we spent time with a number of the large, venture capital firms, a number of AI firms, and folks in that ecosystem to try to get an understanding of what's happening from a technology standpoint, and trying to figure out how do we incorporate more of this into how we operate. And the goal there is to make sure that we're operating as efficiently as possible. How do we continue to add more value for our clients? And how do we make sure we're mitigating risk to the best of our ability, and having more access to data that's helpful in terms of how our traders and portfolio managers trade rebalancing, new issues, corporate actions, all those types of things are going to be really helpful to our team going forward.
And you touched on a couple of points already with Vanguard. Would love for the audience to hear you walk us through some of the core principles that define Vanguard's investment philosophy, and how this has shaped the strategic direction of the company.
Yeah, Vanguard's history, Jack Bogle founded Vanguard almost 50 years ago. And ultimately, Vanguard is very different than most other firms in our industry because of our ownership structure. So we're mutually owned, which means that Vanguard is owned by our funds, and our funds are owned by our shareholders. So there's not a third party, whether or not it's a privately owned family, there's not the public shareholders who are expecting a return. And so when we think about Vanguard, we're operating for the benefit and sole benefit of our investor owners of Vanguard. And so when we think about how do we return value to our clients, it's through either lowering the expense ratio, which we've done throughout the history of Vanguard. The other part is continue to reinvest in our business, making sure that we're launching new products, new services, investing in new capabilities to serve our clients even better. And the other part of it is continue to make sure that we have a strong enough balance sheet when there is bumps in the road from a markets perspective, so we don't have to make any major changes and can continue on our investment approach. So the fundamental philosophy of Vanguard, again, is very different than a lot of other firms because of our ownership structure. And ultimately, what we've always done for clients is continue to have them stress the importance of long-term investing versus, short-term speculative investing that, a lot of folks get excited about, but it's not really the way people should be constructing portfolios for saving for retirement, buying their first house, or saving for their kids' college education.
And you just touched on some of these investor behaviors. From your vantage point and from the behavior that you're seeing with retail investors, are most of the retail investors investing for the long term? Have there been any recent changes in the way that investors behave? Have they evolved over time, and how's Vanguard catering to that, or have they stayed fairly sort of robust and stable? And what we're hearing around some of these more day tradey kind of behaviors is really just a fringe group that is getting all the attention, but is not representative over the overall retail investor population.
Yeah, it's a great question, Max, and I think we have our view is probably a bit different than others in the industry because we tend to attract really long-term investors. So the average holding period for most of our investors is in the neighborhood of about 8 years or so, which is not the case when you look at a lot of other fund holdings and things of that nature. Because again, whether or not people are speculating or they're investing in products because they're trying to either invest in a new fad or something of that nature, we tend not to have. You will not see Vanguard launching products based upon a fad or something that we don't think is an enduring investment strategy that has long-term merit. So our whole portfolio construction process, the products that we offer, again, is geared to those long-term investors who ultimately are trying to accomplish one of those goals that we had just talked about. And again, they're coming to Vanguard because they know what we're about. We're not going to be speculating on new products, new services. We're going to be trying to put portfolios together for them that are going to achieve their long-term goals and do it in a very thoughtful, low-cost way that's going to allow them to achieve investment success over time.
Interesting. Thank you very much for sharing. Is there any? You talked a little bit, maybe as a final question before we jump into the quickfire round. Is there anything that you're especially excited about? You just went to Silicon Valley, you mentioned. Anything that gets you really excited about the future of passive investing?
Yeah, I mean, I'm really excited about the impact that technology is going to have, not just on how we manage money, but also how we serve clients. So when you think about the ability of some of this, new technology to allow our advisors to have better conversations with our clients by summarizing call transcripts and things of that nature, understanding the best next actions to have with clients as we're talking to them about their retirement savings, their families, all those types of things. And ultimately, this technology is going to allow our people to be a lot more efficient, ask the appropriate questions, help position our clients for long-term success. So that's super exciting to me. The other thing I would just say is this technology is moving so quickly. And I'll give you an example. When we were out in Silicon Valley last month, we went to one firm and they showed the ability of this technology. We saw a lifelike image that was created off of a Japanese poem that looked as real as somebody was out there with a real video camera filming this bird. It was about a rare bird in Japan, and the backdrop was mountains and a lake. And this bird was flying around. It ended up landing in a lake. It looked as real as you and me being on this screen. But the reality was, it was all done by AI, and it was driven solely by the language in a poem. Then the crazy thing was, they actually recorded my voice for about 15 seconds. They used that recording to allow my voice to narrate the story about the bird. They pressed another button that translated that into Japanese. So my voice was actually in Japanese. It was remarkable how quickly they were able to put this thing together. And it just shows the power of this technology, how quickly it's changing. And I think it's really exciting to see the impact it's going to have for clients, for investors, and the impact it's actually going to have on our society over time.
Incredible. Wow. So let's move on to the final section of our interview, which is the quickfire round. The first one. So the idea here is I'll ask you a question and you give me a quick answer.
Okay.
The first question is, what's the best investment advice you've ever received?
The best investment advice I ever received was you should really focus on the power of compounding. Compounding is such a magical thing. So the importance of having investing early and benefiting from time. And so a lot of investors don't recognize being in a diversified investment, letting it compound over time, it's quite magical.
And perhaps connected or disconnected with that, what's been the worst personal investment that you've ever made?
Well, I entered. This is a bit of a sore subject. I entered this industry in 1998, right at the height of the dot-com era. Anything with a dot-com on it was skyrocketing. And one of the things you realize is that speculating is not investing, and a lot of these companies ended up going out of business because there was a lot of hype and there wasn't a lot of real material behind some of the hype. And what I would say is the only good news of this story was the fact that I just recently graduated from grad school, so I didn't have much money to lose. I did lose a chunk of it, but it wasn't much to invest at the time. So learning that lesson earlier on in somebody's investing career is very, very valuable as you think about how long you're going to be investing. If it's a 30, 40, 50-year time horizon, it's better to learn that lesson early on when you don't have much in terms of assets.
And when you wake up in the mornings, our audience loves to read. They love to consume information. What's a must read for you that you consume every single morning?
First thing I do when I enter the office is I fire up my Bloomberg, check the top stories, get a sense for what's happening in the markets around the world. And then right after that, I will go through the Wall Street Journal or Financial Times.
And who's your professional hero? This could be someone who's inspired your career, or it could be someone you've met who's been a mentor, or someone you haven't met who's been a mentor, but a professional hero of yours.
I'd say for me, Max, it's been two individuals. One, it was Ken Volpert, who hired me to become a trader on his team to trade bond index funds back in 1999. I had the privilege of working for Ken for 13 years. He taught me everything about portfolio management, the fixed income marketplace, and he also taught me a lot about leadership. And my second hero would have been Tim Buckley, our prior CEO, who really taught me about the importance of thinking more strategically and having broader enterprise impact outside of just my investment expertise. So I've been very fortunate over 25 years to have those two terrific leaders as heroes to look up to.
Amazing. And last question, what would be the title of your biography?
That's an interesting one. The one that comes to mind is From Zero to 10 Trillion. And the reason I would title it that way is I come from a blue collar military family with zero investing expertise. And to move from that type of background to overseeing a team that manages $10 trillion is, pretty satisfying to see that type of transition over my 25 plus years being in this industry.
Well, congratulations on a terrific career so far, and thank you for taking the time to speak with us today, Greg. We wish you all the best, and look forward to all the new technologies that you and your team will be launching for us as retail investors.
Thanks so much, Max. Great being on with you.
As we wrap up the 2024 Modern Investor Summit, I want to thank each of you for being part of this remarkable event. Over the past 2 days, we've covered 14 virtual sessions packed with insights from some of the brightest minds in the industry. It's been a transformative experience with perspectives on challenges and opportunities ahead, and strategies to help navigate an ever-changing economic landscape. Here at Finimize, we're committed to empowering everyday investors like you to thrive in this dynamic environment. And we've been paying attention to what you've been asking for. You've been asking for tactical insights. You've been asking for in-depth analysis. And you've been asking to hear exactly what our analysts think. And we heard you. And that's why we're so excited to share Finimize Pro with you. It's built to give every investor the toolbox to think and act like a pro. If you haven't checked it out, now's the perfect time. We've got an exclusive introductory offer for you. Just visit finimize.com/pro or grab a link in the chat box. And as we close our virtual event now, I look forward to meeting some of you at our in-person event in central London later today. Now, last but not least, I want to say a huge thank you once again to our incredible sponsors, Charles Schwab, CME Group, Victory Hill, Invest Engine, JP Morgan Asset Management, Stashaway, Linkto, Trimaxion, Prospero.ai, Forfi, and Direction. Your support has made this event possible. And as always, staying informed is essential, and together we're equipped to tackle the challenges and seize the opportunities that lie ahead. Thank you for being part of the 2024 Modern Investor Summit. Until next time, stay inspired, stay connected, and we'll see you next year.